Hello, very good morning to all. Welcome to a brand new week ahead. This is Kelvin here. Welcome to today's daily dose of market insights brought to you by OANDA. So today will be Monday, a brand new trading week, 6th of November. So before we start our daily dose of market insights, let's take a look at our disclaimer slides first. Okay, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This documentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, and as well as any forecast, prediction, or projection in this document is not necessarily indicative of the future or likely performance of the product. And this advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we start, this is the usual gist of our daily dose of market insights. Is to recap of key highlights and events that took shape on Friday, and as well as what are the things to look out for today, and even stretching out to early tomorrow morning before 11 a.m. Singapore time. And to round up, we will actually share with you all the short-term technical outlook on the various asset classes, ranging from the benchmark stock indices, the major FX pairs, and as well as the commodities market, primarily the gold and the oil. Okay, so let's have a kind of recap what happened last Friday. So last Friday, we have the releases of two US economic data, the ISM Services PMI data for US for the month of October, and as well as the key job market data, which is the non-farm payroll for October. So both of these data came in below expectation, lackluster. So reaction of the market, for sure, we start to see over optimism or a bit of what I call FOMO rally in the risk assets. That means, i.e., the US benchmark stock indices continue to gap up the second consecutive day. So overall, we see the four benchmark indices average of a daily return of positive 0.271%. That is the top outperformer, the Russell 2000, and the underperformer is the Dow Jones, which is 0.67%. So all in all, what we could see is a very rampant short-term push-up for two consecutive days, also supported by a weaker US dollar in all broad base, which in turn due to the fact of a softness in the US 10-year Treasury yield. So very quickly, right, let's take a look at the expectation right now on the US, most importantly, the US Fed Fund futures pricing. Okay, so very quickly, right, let me take you all to the economic data first over here. Okay, so let me expand my screen so that you all could see. Okay, so this is what happened last Friday. So last Friday, you have this non-farm payroll data in US came in below expectation, 150K. That was way below consensus expectation of 180K. So if you look at the trend of that data over here, it's indicating to us that there is some kind of softness that's being inflicted on the US job market. So this is the level where on the average is the lowest level in the last 12 months or so. Okay, so all in all, higher rates has started to creep into the job market, and most importantly, the services sector, as shown by the ISM, give me a minute, ISM Services PMI data that is out on Friday as well. Services PMI data. Why is it important? You all know that the services sector contributed significantly, close to, I would say, 2/3 of the US economy. So they came in, yet it's still growing at 50. Anything that's above 50 is growing, but it's at 51.8, way below the expectation of 53, and as well as 53.6 in the previous month of September. So what you see over here, if you look at the trend of the growth, growth has started to slow down in the last 2 months or so. Okay, last 2 months. So that's all indicating to us that higher rates has started to be a kind of a negative driver on the US economic growth. So that being said, over here, we start to see a bit of optimism on the US expectation on the Fed funds interest rate. So if you look at the current Fed Fund futures right now, it's actually rather dovish in terms of market expectations. Still recall that previously, right, okay, this is the next meeting on 30th of December. So 30th of December, previously in the previous dot plot, that was actually being projected by Fed Fund officials to at least have one more rate hike before 2023 ends. That means either in November or December. So November last week they didn't hike. So now based on Chair Powell conference, there is also a chance of a hike in December. Why? Because the way he speak over here is that he hasn't even considered any interest rate cut in the near future. So, but because of the softness in the latest data that was being priced into on last Friday, right now we have only very small chance of 9.8% of that so-called expected terminal rate hike to bring the terminal rate to 5.5% to 5.75%. That's the Fed fund rate. So this expectation has been reduced drastically from around 19% about a week ago. Okay, so a very dovish expectation. So that actually also supports that FOMO rally that was seen in the US benchmark stock indices on last Friday. And as well as if you look at the current probability right now, in terms of the aggregated probability as a whole on the next rate, the first rate cut to come in next year. So previously I did share with you all that the first rate cut to come in next year was centered around June or July next year. But if you look at the current situation right now, you have an uptick in probability of close to 60% to come in as early as May next year. Okay, so what market is expecting right now is because the expectation is so dovish that the first rate cut will come in May right now instead of June or July. That means it has been brought forward by 1 month. So market seems to be now touting the fact that, hey, you guys cannot be so hawkish, even though you want to be data dependent, but whatever data that market is actually pricing right now is rather dovish. So can it be sustainable? This we call it optimism in the risk on behavior that was seen on last Friday and Thursday. But the answer to me right now is I cannot be certain. Why? Because if I look at the current market pricing right now of a inflationary gauge data, okay, this is the Invesco DB aggregate ETF, agriculture ETF. That means in short form, it's actually a combination of all the soft commodities together, bundled as an ETF called DBA. So you look at DBA, last Friday it closed at a new 52-week high at 2240, coming very close to the high of during the onset of April and March last year. So what happened last year? This was where during the Russia and Ukraine conflict started, and right now it's intended to actually retest that high again. So what it means over here is that soft commodity prices. So what soft commodity? We name it as agriculture. On the average, we talk about grain, orange juice, wheat, corn. All these prices are inching upward higher. And we know that soft commodities also form a basket of CPI data. That means if commodity prices, soft commodity prices going to inch up higher, potentially in the next 3 to 4 months, it may start to actually creep into your CPI basket as well. So all in all, right, that what I call dovishness that we're seeing in the current pricing of the Fed Fund futures may be just short-lived. Okay, given the fact that if commodity prices, especially the soft commodity prices, going to inch up higher and break above this 23, 25 key upside trigger level, potentially you will see the next resistance at 2830/2930. So that could actually increase inflationary expectation. And if you look at inflationary expectation over here, it's not coming now. So based on the ETF, because there's actually an inflationary expectation ETF, they call it RINF, is listed on the New York Stock Exchange. It's been slowly inching upward as well. This on a weekly chart. So on Friday, it actually inched up 0.3% and also going to retest last October high. All right. So all in all, right, what we could see over here is that inflation expectation is actually not back coming down. It's inching much higher based on a market transacted data. Okay, so all in all, what it means that based on my opinion right now, it seems to be a bit optimistic on the Fed funds future pricing as of the latest price session to be so dovish. So we should see how the market progress from here. Okay, so this is the we call it the angle from the fundamental perspective and the macro perspective that I share with you all. And now moving on, what are the key data to look out for today? So if you look at today's calendar, so let me bring out the latest calendar for today. Okay, this was last Friday, so let me put it up for this week. Okay, so data up for this week, right? For today, it's pretty much so we have the final PMI data out from Eurozone, so that's the final, more or less. There's no big surprises. So so pretty much quiet day for today. And do not forget, today the daylight savings ended in US. So for the US session, it will start at, instead of 9:30 p.m. Singapore time, it will kickstart at 10:30 p.m. Singapore time today. All right. And for sure it closed 1 hour later at 5 a.m. Singapore time. So over on Tuesday over here, what is the key data to look out for is at 11 a.m. next, means tomorrow, Tuesday, the balance of trade data for China, and as well as RBA interest rate decision out at 11:30 a.m. Singapore time. So very interestingly, RBA right now, right, the due to the fact of the previous minutes kind of peppered with a bit of hawkish vibe, and as well as the monthly CPI indicator, means the monthly CPI, not the quarterly one, has started to inch up but higher. Market now is just pricing in, after 4 interest rate pause, to at least have a 25 basis point hike coming in on Tuesday, tomorrow, at 4.35%. So that's above, that's kind of more or less being priced into the market already, given the fact that the Aussie dollar has started to raise up pretty steeply after that emergence of that bullish descending wedge configuration, which I shared with you all last week. So what's interesting over here is that more or less it has been priced, it kind of priced it, because you look at the RBA interest rate futures as of last Friday, also 50% chance of an increase or to 4.35%. I think what's most important over here is market wants to hear the statement going forward, what's the forward guidance look like in the statement that is being add out right after tomorrow's interest rate decision. Okay, so with that, right now, let's us take a look at the technical chart. Also, let's start with the FX market first. All right, so let me hide myself so that you guys could actually see my screen much clearer. So let us start with the FX market. Okay, so on the FX market over here, what we are actually seeing. Okay, so let us start with the broad-based dollar index first. So you look at this, the broad-based dollar index. So this broad-based dollar index, what we could see is that previously it has been trading above the 50-day moving average since early August this year. And what you see, last Friday, price action had broken down below the 50-day moving average at 105.65, and now inching towards the test, the next support at 104.40 slash 104.50, which is the 200-day moving average in orange at this point in time. So what you could see over here, right, it means that this medium-term uptrend, right, since the low of July this year, represented by the 50-day moving average, as we could say, is in jeopardy right now and is due for a much more multi-week corrective decline to test the next support at 104.40 slash 104.50, 103.50, this level over here. Okay, so all in all, right, we do expect a bit of more multi-week dollar weakness coming back into the market. Yeah, this level. Okay, this range here. So, and RSI also pretty much bearish since breaking below the 50 level and hasn't hit the oversold region yet. So all in all, right, multi-week perspective appears to be much more bullish than bearish for the dollar. Okay, so, but however, on a very shorter term, right, we do expect a bit of pullback. Shorter term, as in we talk about intraday. So intraday, that means we do expect a bit of pullback in this dollar weakness. So it's starting with the euro dollar, right? If you look at the euro dollar on the hourly chart over here, what you could see on the hourly chart, the RSI has already been in an extreme overbought level. Okay, extreme overbought level. So what we could see over here is that the euro dollar has hit our resistance level that we mentioned last Friday. Last Friday, we have that bullish bias, 10735 slash 10760. So now it's coming very close to this resistance zone over here, this congestion zone of 25th of August at 13th of September at 10765 level. And also, if you look at the ascending channel, the minor ascending channel that I could draw from the start of this steep short-term stiff rally from last Thursday, that means ex-post US, we call it Fed Chair Powell press conference. So right now it's actually coming very close to the top of that ascending channel as well at 106.75. So all in all, what we could see over here, given the RSI kind of at exiting from this extreme overbought level, there's no bearish divergence yet. So I would rather be a bit more neutral for today, between a wider range channel. Okay, lower limit of this descending channel. I think there's something wrong with the microphone. I hope that you all could hear me. Okay, 1 second. Let me test again. Okay, mic test. Okay, test 1 2 3. Okay, I hope that you guys can hear me right now. But I think there's something wrong with the microphone earlier. Okay, let me do a check. Okay, so what I can do over here is, yeah, I think let me do a check again on the microphone. Test. Okay, good. I think all is good. Okay, so basically where we are. So we are at the euro dollar. So prefer to be have a neutral range between 107.65 followed by 106.70, which is the lower limit of this minor ascending channel support, and as well confluence with the minor swing high of 31st of August and 2nd of November turns to a pullback support. So neutral between these two range, unless we start to see a breakdown and hourly close below 106.70, then potentially we could see a retracement of this last Thursday and Friday steep up move to retest the next the intermediate support level at 105.90, maximum 105.20 zone. All right, so we are now more looking for a kind of a pullback to a better entry level, potential better lower level for a better reward risk ratio trade setup, given that the price is really coming very close to a resistance level on the euro dollar. But for sure, if we start to see a breakout above 107.65, then we could potentially see the continuation of this squeeze up to test the 200-day moving average, acting as a resistance at 108.10 slash 108.60, which is the next resistance level, which is confluencing with this congestion zone over here, and as well as the 50-day retracement, Fibonacci retracement of the last push down from the high of 18th of July to 4th of October. So that was the last down leg seen in the euro dollar. Okay, so neutral for euro dollar for today. So if we go to the sterling dollar, so on the sterling dollar over here is very fast approaching the 200-day moving average. So on the 200-day moving average over here is at 124.40 level, 124.40 level. We also confluence with this minor congestion zone area over here, and as well as the 38.2% Fibo retracement of the last down leg from July high all the way down to the early 4th October low. So with that, right, I will actually looking for more of a pullback right now, given the steep up move in the sterling dollar. So as long as 124.40 kind of a short-term pivotal resistance is not surpassed to the upside, potentially looking for a pullback towards this support level at 123.30 slash 122.85. We also confluence with the 50-day moving average acting as a support level, and as well as the minor swing high of 11 October and the former minor swing high of 24th of October. So kind of looking for kind of a counter trend bearish bias approach after this steep rally that was seen on last Friday. So using 124.40 as a key short-term pivotal resistance, potentially looking out for this short-term bearish bias counter trend. But however, if we start to see an hourly close above 124.40, then this counter trend, bearish counter trend condition will be invalidated to continue to see the squeeze up of this very steep rally towards 125.10 slash 125.40 on the sterling dollar. So that's the outlook for the sterling dollar for today, short term, yeah, for today. Then switching on next will be the dollar yen. So if we go before on the dollar, let me talk about the sterling dollar first. Not sterling dollar, the Aussie dollar. So the Aussie dollar, right, from a medium term perspective, right, if you look at the daily chart on the medium term perspective, the trend has started to indeed change. So it may start to form a double bottom configuration on the daily chart. Why? Because of this bullish descending wedge breakout above the 63.95 level. But right now we got to be contented with a bunch of resistance from a multi-week perspective. 65.95 breakout above this level potentially sees the descending trend line resistance from 25th of February 21 high that is still in place on 25th February 21 high, acting as a resistor at 68.15 slash 69 figure level. So that's for more of a multi-week perspective, but for sure right now from a medium-term perspective, that means i.e. we're talking about a trend ranging from 1 to 3 months, it appears to me that to be heading towards this zone over here. 65.95 taken out, that 68, 15, 69 figure level. So from a multi-week to multi-month perspective, the bullishness seems to be coming back to the Aussie dollar. But do not forget, market don't go up in a vertical fashion. So on a daily basis, right, if you look at the hourly chart right now from an intraday perspective, let's stress intraday perspective again, on the hourly chart over here. Okay, look at the hourly chart. So on the hourly chart, what we could see is that the RSI for sure is now, after hitting an extreme overbought level, is now trying to inch down to exit from the overbought level with a bit of exhaustion candlestick that is being formed in the last 3 to 4 hours since last Friday, right below this minor descending, minor range resistance at 65.20. So what 65.20 is the minor swing high of 31st of October and 1st of September. So I'll be using 65.20 as my key short-term pivotal resistance for today ahead of RBA meeting tomorrow to look out for a potential bearish counter trend, bearish counter trend setup, short-term bearish counter trend setup towards the intermediate support at 64.45/64.20, this zone over here, which confluence with the minor swing high area of 11th of October and 2nd of November, and as well as last Thursday's swing low area that also confluence with the 38.2% Fibo retracement of this very steep rally that was seen in last Wednesday. Okay, 38.2% and 50% retracement. So all in all, right, potentially we may due for a potential counter trend. We call it pullback within this very steep up move that was exhibited last week. But however, if we start to see an hourly close above 65.20, that means a breakout with an hourly close above 65.20, then potentially this very steep rally could resume to retest the 200-day moving average, acting as a resistance at 65.95. So that's for the outlook, intraday outlook on the Aussie dollar short term. Yeah. So now going for the dollar yen. So dollar yen, if you look at the perspective from a daily chart first, so for sure, what we could see is that we very clearly we see a weekly close and a daily close below the 20-day moving average. So right now, potentially, right, from a multi-week to multi-month perspective, we could see further weakness heading down towards to retest the 144.80 medium-term key support level. Why is it a medium-term key support level? Because it confluence with this medium-term descending channel support level from 25th of March low, and as well as the congestion zone from 30th of June and 1st of September level. And if you do the Fibo retracement, taking from the lows of 24th of March all the way up towards the high, okay, pardon me, from Jan over here, it converts very close to the 23.6% retracement as well. Okay, so all in all, right, we now start to see further medium-term weakness potentially seeping into the dollar yen rate. So what's the outlook for the shorter term perspective? That means intraday perspective. So on the intraday perspective, right, if you look at the hourly chart of the dollar yen, last week we were actually have this bearish bias looking for a further push down to test the next support level at 148.90. So 148.90 for sure is a very key congestion support zone over here. Tested one time 30th of October, tested the second time on 17th October before they shaped their bounce. Okay, so last Friday it came very close to it before it attempt to do a pullback again. So all in all, what I could see over here is that the RSI now has started to exit from the oversold region, hasn't hit the overbought zone yet. So potentially, what we could see over here is that we could see a bit of retracement of this ongoing downtrend that is being in place since last Wednesday, this minor downtrend that is breaking below the, already broke below the 20-day moving average. So if we do the Fibo retracement over here, the close to the 50% over here is at 150.60 level, which is the minor swing high of last Thursday and last Friday. Exposed non-farm payroll and exposed the ISM Services PMI data release. So I'll be using any potential pullback in price action to fade the strength, potentially below 150.60. So as long as price action, this potential snapback rally don't surpass 150.60, we could still we could still maintain that bearish bias, bearish bias on the dollar yen heading towards the 109.90 level. A break below 109.90 level, which is also the 50-day moving average, potentially could see further potential downside, at least in the short term, to retest the 5th of October and 10th of October swing low area at 148.25. That's for a more of a short-term intraday perspective. But however, on if today it starts to shape a hourly close above 150.60, then potentially we could start to see another round of recovery, choppy recovery on the dollar yen to retest the major resistance at 105.95. So what I could do, i.e. what we will have a tightened key short-term pivotal resistance for today. Potentially we could start to see a further retracement, because the price today retraced today. I don't want to chase this retracement, so I'll be using very closely this zone over here around 149.80/105 105.60 to fade this rally, using 105.60 as a key short-term pivotal resistance, to actually see a continuation of another potential down leg to retest 108.90. A break below 108.90 will potentially seize the next support at 108.25. All right, so that's the short-term intraday technical outlook for the dollar yen. Okay, as long as 105.60 key short-term pivotal resistance holds, the bias is still towards the bearish side of the story. Okay, that's for the dollar yen. Now, moving on will be the stock indices. So let us start with the Asia indices first. So over here, the stock indices, what you see, the Asia benchmark Hong Kong index continue to be bullish after the breakout of the 20 and the 50-day moving average. So last week we have a bullish bias at resistance at 17,870, which has already been surpassed to the upside. So all in all, right, what we could do over here is that we will be using price action has raised us to actually move up much higher, a breakout. So we're now heading towards the next resistance level, which is this key medium term key minor range resistance, from the 15th of September swing high and the 12th of October swing high at this 18,350 level. So if you look at the 200-day moving average, right, it's still way below this level, but we are taking one step at a time. So for sure, you got to surpass this 18,350 first before heading up towards the 200-day moving average. So for a short-term intraday, we still maintain that bullish bias above 18,350, but to have a better reward risk management perspective, so I will actually having a very tight key short-term pivotal support level for today, given price action has really inched up higher. And the RSI, yes, even though it's overbought, there's no bearish divergence being seen at this point in time. So I'll be using last Friday swing high area before the burst up, exposed non-farm payroll and exposed ISM PMI data, and also very slightly below the 50-day moving average at 17,006. Okay, give me a minute. 17,675. Okay, so I'll be using 17,675 as my Titan key short-term pivotal resistance, pivotal support level. Okay, so this will be my Titan key short-term pivotal support level to maintain this short-term bullish bias to test the next resistance at 18,350 level. So all in all, right, if we start to see hourly close below 17,675, then potentially, right, this up move will be in jeopardy again to see another choppy down move to retest the 20-day moving average, I think, as a support at 17,470. Then even much a break below this level potentially could see the lower limit of this medium term range support at 17,170/16,690, 16,980 level. Okay, so all in all, having a Titan key short-term pivotal support for today, 17,675, to maintain that short-term bullish bias on the Hong Kong 33 index towards 18,350 resistance. Okay, now going on next will be the German 30. So German 30, right, we are looking for a push up on last Friday, using 15,410 as my key short-term pivotal resistance to play that potential short-term decline. So price did indeed shape that push up, heading towards the 15,280 level on last Friday. Then also, if you look at the RSI also start to shape that bearish divergence as well. Okay, price action shape higher high, but RSI is not showing higher high at all. Okay, so all in all, right, I do not want to be so tight at 15,280 because the market hasn't opened yet for the German 30. So I'll be still maintaining 15,410 as my key short-term pivotal resistance level, which is the 50-day moving average, slightly above it, and as well as the descending trend line descending channel resistance that is in place since 31st of July this year. So still maintaining that bearish bias, at least looking for a test towards the near-term support level at 15,090, which is close to the 20-day moving average. A break below it potentially could take us down lower towards 14,920, which is also the minor swing high of 24th of October and 26th of October. That confluence with this minor ascending trend line that is in place since this late October low. Okay, but however, if we start to see an hourly close above 15,410, then potentially we could start to see a much more substantial medium-term recovery in first step to test the next resistance at 15,560 slash 15,660, which is the 200-day moving average, I think, as a resistance as well. Okay, so that's for the German 30 index. So going on next will be the Dow Jones. So Dow Jones industrial average going to pierce up much higher, and right now is fast approaching the medium-term descending channel resistance that is in place since 2nd of August high this year. So all in all, right, what we could see over here is that a bit of we call it a bearish divergence as well on the hourly RSI. Okay, so with that, right, we will be having much of a neutral stance for today for the Dow Jones Industrial Average. So more of a neutral range between 34,300 and 33,885, which is close to the 200-day moving average right now, I think, as a support level, given that the price up move last Friday has taken out the 200-day moving average and 50-day moving average. So it's close to between the 50 and the 200-day moving average. So for sure, this is a lower range important boundary in order for the bullish we call vibe to actually survive for today. So, but however, if we start to see an hourly close below 33,885, then potentially, right, that bearish bias tone could actually set back into the market again to see at least a retest of this intermediate support level at 32,560 slash 32,390, which is the lower boundary, which is the 20-day moving average, I think, as a support as well, and as well as this minor ascending trend line support from the low of 30th of October. Okay, so that's more of a neutral stance for the Dow Jones Industrial Average. Okay, before we go there, a breakout above 34,300, that means an hourly close above 34,300, then potentially we could start to see the recovery scenario take shape for the Dow Jones Industrial Average to see a much more substantial rally to the next resistance level at the minor swing high area of 31st of August and the 15th of September, 35,020 level. Okay, then it's very similar for the Nasdaq 100. So Nasdaq 100 going to squeeze up above the 50-day moving average, and right now it's coming very close as well to this medium-term descending trend line, very similar to one that I drawn on the Dow Jones Industrial Average. So prefer to turn neutral for the Nasdaq 100 as well, and given the fact that the RSI is also shaping that mild bearish divergence that is being seen, the bearish divergence that's being seen on the hourly RSI as price going to squeeze up on last Friday. So neutral between 15,225 and 14,970. If we start to see a breakdown below 14,970, at least in first step, we could see a pullback down below 14,780. A break below 14,780, which is the 20-day moving average, then potentially, right, what we could see over here is that this short-term push up over here is more like a bear market rally or a dead cat bounce rather than the start of a much more substantial recovery in order for the price action of Nasdaq 100 to actually hit down lower towards the 14,425 next resistance level and support level. Okay, but however, if we start to see a hourly close above 15,225, then we will start to see a much more substantial recovery on the Nasdaq 100, that means potentially could translate to the rest of the major US stock indices in first step to hit up towards the next resistance level at 15,540, which is the minor swing high of 4th of September and 15th of September level. Okay, so that is the next resistance level to watch in first step if we have an hourly close above 15,225. Okay, so that's for the benchmark US stock indices. So let's maybe take a look at gold right now. So for gold, still no change, right? It's still kind of sideways after the release of that non-farm payroll data and the dollar weakness coming back in the picture. So still using that 19,774 level as my key short-term pivotal support level. So unless we got for sure, we got to see a very clear breakout above 2006, then potentially the odds will be higher to start to kickstart another bullish uplift to test the next resistance at 2028/2037. But then we have if we have an hourly close below 19,074, then we could start to see the start of this potential retracement, a pullback to retrace this recent 4 weeks of up move towards the next support level at the 1932/1920 level, which is the 200-day moving average and the 50-day moving average, acting as a support zone as well. Okay, so these are the two key levels to watch on the gold: 1974 on the upside, 2006. Okay, now for WTI crude is rather mixed right now. So if you look at the hourly chart for WTI crude, it's going to trade in a very sideways range on last Friday. So still looking for this range bound configuration between 84.58 and 81.16 level. Unless we have an hourly close below 81.16, then potentially we could see the continuation of this short-term downtrend to test the key medium-term support level at 78.70, which is also confluence with the 200-day moving average, and as well as the swing low area of 23rd of August and 24th of August. All right, so neutral between these two range for gold between 84.58 and 81.16 level. Unless we start to see a breakout above 84.58, then potentially we could see at least a short-term recovery to retest the 50-day moving average, acting as an intermediate resistance at 87 figure level. We also confluence with this minor congestion range that is in place since the start of 19th of October to 28th of October. Okay, so that's pretty much sum up. Today is a bit longer because I need to cover a slightly more, we call it developments that took shape on last Friday after the release of key US economic data. So with that, have a great day ahead, and we shall speak again tomorrow. Okay, all right, so thank you for your time.